Well, good afternoon. Good afternoon and welcome to another of our webinar Wednesdays hosted by CSU Bakersfield Small Business Development Center. I'm Kelly Bearden. I'm the director here at the SBDC located in downtown Bakersfield. And no, that snow isn't here in downtown Bakersfield behind me, but since it's about everywhere else, we thought we'd go with it today. So welcome again. This is webinar number 265 of our series that began a little over 10 years ago. And for the first time in a considerable amount of time since it was 109 degrees. I don't have a guest today. So we're going to go through a lot of the questions that I've kind of been shortchanging you on a little bit and go through some of the key concepts that are important to many of you. And if you've got questions today, just go to the question box and put them in the Q&A box, and we will get to those today. If you do have questions, try to keep them a little bit more on the general side of things where they'll pertain to a lot of different individuals, and we will take those questions and go from there. So coming up next 2 weeks on Webinar Wednesday, next week we will have Richard Mostert. He's going to be talking about the San Joaquin Finance Center that's coming online in the San Joaquin Valley. So the San Joaquin Valley Finance Center, that is going to be an effort of our SBDC program. And then on March 15th, we're going to be talking about Succession. I guess that television show's coming back on, and so is Morgan Clayton and his daughter Tasha to talk about the succession of their business and how a 4-decade business went through the succession process. So it should be a dandy. So what is up today? Today, March 1st, 2023. Well, it's not May Day or April Fool's Day, which will be our next two first days of the month coming up this year. It's March 1st. With little fanfare, we begin March 1st with a little bit of hail, a lot of weather going on, and just really a nice winter coming out of a lot of drought action the last 4 years. So today we will take your questions and we'll at least the ones that I can answer today. So if you have questions about any particular topic, we will open it up for opening questions. We will cover a good amount of work on small business lending, selling a business, a little things like that, go through our regular capital quarter and other things. But we will start on the three on lending, financial information, and also selling a business, just really quickly to get the ball rolling. We'll have the business news for you here in 2023 on Webinar Wednesday. So let's go to our poll. We do have a number of poll questions today. And we're going to start with number 1. And our first poll question is going to be we're going to be a little limited today on talking about restaurants today, but we thought our first one would be, according to Toast, which state, and Toast is a point of sale system that has 68,000 users, what state is generally considered the least generous as far as tipping? So yes, there you go, the least generous state as far as tipping. So we have 4 choices for you. We have California, West Virginia, Kentucky, and Utah. And we have already 50% of you in. So what state, according to Toast, which has 68,000 users, as I mentioned, I believe, and access to a lot of information around the country based on being that platform. So is the least generous tipping state California, West Virginia, Kentucky, or Utah? So with 65% of you in and 3 other poll questions, we're going to end this poll right now and share the results with you. And as you can see, you think 38% of you think it's West Virginia, 31% Utah, and 31% California. Nobody thinks Kentucky is the least generous. Well, those people are right. So let's go to California is the least generous tipping state. If you go to number 49 on that list, it's also Washington, Maybe, I don't know, maybe tippers are looking at total compensation and feel maybe some of the West Coast states and some of the other higher minimum wage states, maybe they don't need it as much. But number one on that particular list was Indiana. Number two was the state of West Virginia. So there you go. I guess we have some work to do there. So let's move on to poll question number 2. Okay, so poll question number 2 we're going to launch is, what cuisine saw the biggest increase in 2022? Was it Italian, Japanese, Chinese, or Thai? So we're looking at the type of food that experienced the biggest increase, and this was for quarters 2 and 3. Quarter 4 isn't out yet. But of these cuisines, you know, they're all good, aren't they? One of them experienced much higher growth than the others. Is it Italian, Japanese, Chinese, or Thai? So we're going to give you just a couple of moments now to get in. We have 68% of you in. Thank you for jumping in and participating. And we're going to go ahead and end the poll with 72%. Nice number. And we'll share the results with you. And sharing the results, 44% of you believe that it's Thai, while 25% believe that it's Italian, 19% Japanese, and 13% Chinese. Well, I would have got this one wrong too, my friends. And actually, it was Chinese. And that surprised me. Coming out of the pandemic, I figured there were better to-go options with Chinese food, but Chinese food was, at least nationwide, the number one gain, something like 22%, 23% over the previous year. So they're a little surprising. Thai was number 2, and down toward about number 6 of the highest increasing cuisines for 2022 was Italian, which I would have picked. So chalk me up for getting that one wrong, and congratulations on those 13% of you that got Chinese correct. And on to poll question number 3. Poll question number 3, sticking with our food theme so far. Going to launch the third question, and that is going to be, over the past 3 years, the average price of a cheeseburger has increased by how much? Is it 20%? Is it 37.5%? Is it 80%? Or it actually decreased? It didn't go up at all, huh? Okay. So last 3 years, we've had inflation for the last 9 months, but before that, we had 2% inflation for a couple of months. And actually, did it go up 20%? Did it go up 37.5%? Did it go up 80%, or did the average price of a cheeseburger actually decrease? Okay, let's see how we're doing here. We have 58% of you in. So give you another moment or two to jump in on the average price of a cheeseburger. How much did it increase, or did it decrease in the past 3 years? Okay. Feeling like a tree that has been cut down. You know that word, stump? So let's end the poll. 66% of you in. Share the results with you, and we see that 69% of you chose 37.5%, which I believe is 3/8%. 3/8 is a fraction. That answer is incorrect. It is 20%. 19% of you got that correct. 6%, you know how I love the 20/80, was going to be one of them, right? Usually, not always. And 6% thought it might have decreased. Last question, and we're going away from food. We had a question a few weeks ago when we got whimsical, and we were talking about Pronounced, the first album by Lynyrd Skynyrd. And I wasn't actually able to show the last poll. So I'm going to use that poll and end up a little whimsical today. And this poll has to do with Lynyrd Skynyrd had 3 backup singers that sang in the band. So what was the name of the backup singers? What did they go by themselves? Did they go by the Dudettes, the Mouths of the South, or the Honkettes? So Lynyrd Skynyrd was our focus when we had Dr. Machika on, from our economist. And we talked a little bit about trying to get this fourth question out then and had a problem, but it's the name of the backup singers. What is the name of what the backup singers literally call themselves from the band Lynyrd Skynyrd? Is it the Dudettes? Is it the Mouths of the South or the Honkettes? Got 48% of you in. Need a couple more votes to get over at least 50%. Oh, that did it. Thank you so much. Last chance to get in for the backup singers of Lynyrd Skynyrd, the Dudettes, the Mouths of the Souths, or the Honkettes. And we're going to jump in right now and end that particular poll. 60% of you, thank you for participating, and share the results with you. And yes, 47% of you said the Honkettes, 27% the Dudettes, and 27% the Mouths of the South. Thank you for participating. The Honkettes, what a great name, I thought. So named after the honky tonks here in Bakersfield and other places, the Honkettes. So there you go. There's our poll for today. So let's get into some serious stuff. And here's one for you. We haven't had this one up for a while. It's kind of the status of the programs. And put it up here in honor of the Kern County Micro Grant Program that just opened again, and has about, I believe, last time I checked, maybe around 60 slots still open for $2,500 worth of funding. We'll talk about that in a bit. The employee retention credit, that tax credit that has been open retroactively for periods of 2020, 2021. We've talked about it quite a bit over the last year and a half, maybe. It is still open. If you experienced any physical damage or any, economic injury because of the storms, the damage application would be due very soon. So you're going to want to contact FEMA or SBA. That it does not matter if you've had, say, any snow damage, any collapsing, anything going on with that of this storm. It had to be related to the December 27th incident. Just a little tease coming your way. The city of Bakersfield is going to have a small business program that's going to be coming soon. And we're excited. It's going to be limited to certain census tracts within the city of Bakersfield, those lower to moderate income areas and individuals that live in those areas, potentially grants, potentially to start businesses, maybe existing businesses. We'll have details soon. So stay tuned. That's going to be coming. Hopefully have more information on that later this month. The California Dream Fund, the final grants are being paid in that particular program. And now we're looking to see, is there going to be another? Is there going to be a Dream Fund 2.0 this year? It's possible. It might depend on the situation of the state's finances when the governor does a revise in May. So I'll get more information on intel on this later this month as well. We'll be talking about that if something is coming that way. My favorite acronym is the State Small Business Credit Initiative. Yes, SSBCI. And they have a small venture grant fund, and we hope that it's going to be opening some of that money that has been is being given to some of those groups. The $200 million that's out there is going to be coming our way to some of our small businesses in the venture fund. So we'll have more information on that too soon. We haven't talked about PPP forgiveness in a long time, but you can still apply. If you did not, and you're making payments now, apply for forgiveness. Or if you had some particular issue, it's not too late. You can still get forgiveness even if you've started repaying your PPP loan. So keep that in mind. And also our COVID EIDL loan, where your repayment starts 30 months from when your loan originated on. Everybody probably has a different date on that one. So it's 30 months from that timeline. We also have some information you might want to call. If you're getting additional financing for your business, you're going to want to check with SBA. You do have a particular lien on that. You signed a loan authorization and agreement. The LLNA also had a blanket security pledge. And really, if you're going to sell assets, if you're going to refinance, it's just something that's a good thing to do, is to call the SBA's call center, the EIDL call center, and talk to them about it. So keep that in mind, that moving forward, if you have a COVID EIDL loan, you have the disaster loan caused by COVID, and that loan is for 30 years. For 30 years, if you pay that off over that term, those assets that you get rid of are all covered by this blanket. So keep them in mind. They are going to probably make decisions based on the best possible decision for your business, but do that to stay out of trouble with the SBA. So a little bit about the Kern micro grant program. Haven't talked about that in several months. Thought we were out of money a couple months ago, but a little bit more surfaced. The key provisions of that are it's up to $2,500 per business. You had to be in business in 2019. It had to be your main source of revenue, your main source of income for the individual who was applying. There are certain nonprofits that are eligible, and you cannot have more than 5 full-time equivalent employees. So here at the SBDC, we've worked over the last year to assist and package and gain approval for eligible applicants. And it really is nice because these really go out to our smallest micro businesses that sometimes we don't touch. So if any of you know of anyone who has a very small business and was in business in 2019, we'd like to talk to them and try to help them get this $2,500. And also maybe even talk to one of our consultants on the bigger picture and look at, how you could particularly grow this micro business into a larger business. So keep that in mind, but that is still available. So also storm relief for California businesses. So there are low interest rate disaster loans that are available. Both on the physical damage, if you had any flooding or any wind damage or maybe tree or whatever that began with the severe winter storms at the end of December in 2022. Those loans can go up to $2 million. But if you had any physical damage, any physical property damage, you really need to, you're down to about a week or two on that. I believe you have about a week to 10 days in order to get that in. And that will be the end of that. Now, if you suffered an economic injury from the disasters, then you have plenty of time still, because, that doesn't end until November 15th, I believe, of this year. And the reason is property damage, you would know that it has occurred. Your economic injury, it still could come from some of the damage in some of the businesses that haven't reopened. Maybe they're your suppliers, your vendors, your key people that are actually buying your product. I always like that, your customers. So keep that in mind, that you can actually still be injured from an economic perspective, and that it would be similar to the COVID EIDL, but it would be the EIDL program. There's some information right there as far as disaster customer service at sba.gov. That is true for this disaster, and it's also true if you have a question regarding your COVID EIDL loan. And there's a website that FEMA has, so there's both FEMA and SBA that are doing part of the disaster from those storms that happened late last year. So our capital quarter, actually, it's not quite blank today. It's looking rather blank, or maybe like blizzard conditions on this particular page. But actually, we've got a lot of things to discuss along this line. So our capital corner, we're going to start with our key tips for funding. So, one thing that you're going to want to do, I believe that if you are looking for funding, is to look at the big picture. And looking at the big picture is developing a funding plan. So we do a business plan. Some businesses do a technology plan, a strategic plan. A funding plan is not a bad idea at all. And what it'll do is it'll give you kind of the basis of what you're looking for for your money. It'll put you in a better position to ask and answer questions from your proposed lender. So what is a funding plan? Well, it's going to probably start with your immediate need. And your immediate need, what you're looking to finance now. And oftentimes businesses will go through a phase of where they will fund a particular need for their business now. Maybe it's an expansion, maybe it's getting a lower rate on some of the assets that you've purchased in the past and kind of like a refinance. Maybe it's to add permanent working capital because everybody needs permanent working capital in their business. But developing that plan not only addresses what you're needing right now, but how you see your business growing over the next, I would say, 2 to 3 to 5 years, and what your needs are going to be then. So your needs might be right now is permanent working capital, increase your inventory, getting your business to that next step to grow to where you will increase your revenues and increase your bottom line. And maybe if you rent, maybe in 5 years, it's to actually have a plan to quit renting and to buy your own commercial piece of property. Talk to our friends at Mid-State Development who have excellent loan programs, SBA programs for buying and actually investing in real property for your business. So you're going to want to look at your immediate situation and then look beyond. And some of the things your financial plan could have is it could have what you're going to purchase. What do you need the money for? And also looking at, oftentimes in the lending process, we will look at a variety of different factors. You will often hear lenders talk about their 5 C's of credit, Number 1 being the condition of your particular business and industry. So you're going to want to, in your funding plan, look at that particular condition. You're going to look at capacity. What is your capacity to grow? What is your capacity to grow from both a funding perspective and also a collateral perspective? So collateral is a big issue. What is the capital that you have? Oftentimes, in most cases, business loans require a down payment. So do you have resources, either cash or assets, to inject that can work as that down payment? So your capacity is always important. Mention the collateral. So those are all things, along with your credit history and making sure if you have some credit issues, maybe you clean those up. I think one mistake people make is when they're looking for funding is if they're not really attractive to a lender right now, they go away. And oftentimes their idea goes away, and oftentimes they just kind of do either 2 things. They either close the business or they continue along. But you can really kind of position yourself to maybe be more fundable 12, 14, 16, 18 months down the road. Trust me, 12 to 18 months happens pretty quickly. And you can do a lot to better position your business to get into a better shape to receive funding, kind of by going through the plan and planning things out, working on credit, saving money, etc. So look at what you need now, but look beyond your immediate need. Another thing I think people make the mistake of is they don't always find a lender that is appropriate or active for their situation. So when at the SBDC, when somebody comes and asks to is looking for funding, we always first have them meet with their existing lender or your existing banking relationship. So maybe you don't have a loan and maybe it's with a particular bank, but always try them first. A lot of people also, a misconception that we see is that people oftentimes think that an association, say with a larger bank, I've been with this large bank for 25 years, is going to position you in a better position. They're going to look at everything on a transactional basis. It's going to be based on this transaction that we're going to go through a lot of the things that can maybe turn a no into a yes. But find a lender that is active in that particular area that you're funding, that they're offering the size of loans. Oftentimes, some of the bigger banks, they will participate in an SBA program that is for smaller banks or microloans. And maybe you need much more than that. So ask the questions and find out the particular situation with the lender that you're working with. The other thing I think is important is that you have to understand where the lender's perspective is and their process. Oftentimes now, you're not actually talking to, in almost every situation, you're not talking to the individual that can make that decision. You used to be able to. You used to be able to sit down with a banker. You would pitch your particular program, what you need the money for, and that particular deal could be done there. Now, most lenders have a credit manager, a credit underwriter, and also oftentimes a loan committee, depending on the size of the loan. So actually understanding your process and what your lender needs to do and needs to take that. And generally, the underwriter is kind of in a different position. The person you're dealing with wants to get you that small business loan, but you got to make it as easy for them as possible. And understanding their process, a lot of the financial ratios, and a lot of the things out there. We'll talk in a few minutes about a financial ratio that most people don't know, but really some of the financial information that you're going to provide your lender is very important. Also, I think it's important that you be creative. And there's a lot of money out there. There's a lot of different ways to fund a small business. There's a lot of ways of being extraordinarily creative. There's, I could give you a dozen examples right now about how you probably haven't heard of people, how they fund businesses. We'll give you a few in a minute, but be creative. There's a lot of ways out there to fund a business. And oftentimes, if you need, let's say $250,000, oftentimes it's easier to divide and conquer that $250,000. Now, obviously, the best and easiest way would be to get one loan and get it into one amount. But oftentimes it's easier with smaller pools of money to get accepted and to be approved. So sometimes we actually talk about some of the different pools of money that you can get to, or maybe even stage that over a particular period of time. So a lot of different ways, and really your creativity is the best tool that you have if you are, say, in the marginal category. I generally, when I look at financial information, people are either bankable, meaning that they're going to get a loan from a bank. There's people that are near bankable, that it's really close. There are people that are probably not bankable, and there's a variety of issues. Maybe the lender doesn't make startup loans, etc. But there's a lot of areas to where they're not bankable, either by the amount of time they've been in service, or one of those 5 C's that I talked about as far as credit history, etc. So understanding that and then trying to use some creativity can take you a long ways. Now, this is really, I think, the debt service coverage ratio is something that I think almost every lender will calculate, and very few borrowers know anything about it. So essentially what this ratio is doing, the debt service coverage ratio, is it's measuring the cash that's coming into your business, and it is divided by the amount that you have as far as your current debt obligations. So let me just show you what it looks like real quick, and then we'll come back to it. There it is right there. It's your net operating income essentially divided by your debt service. So why is this important? Is because most lenders will come and they'll tell you that they're cash flow lenders. If you have cash flow that's generating from your business and you can support that they're a cash flow lender. So what this is measuring is generally a minimum ratio that they will accept. And oftentimes I have seen deals that have been really solid, and then all of a sudden the debt service coverage ratio isn't high enough. In most situations, the most common ratio I see is 1.25. So it means you must have 125% of your cash flow over your operating expenses. So that being said, oftentimes it depends on the economic conditions, what is happening. It depends on the lender. If you're working with, say, for example, a nonprofit lender, Sometimes you will see it something similar to 1.0, but understanding this ratio and calculating it in advance and looking at your finances and talking with somebody before you talk to a lender is, I think, very important. So this is the debt service coverage ratio. And again, it is used to calculate basically the cash flow that's available to pay your current debt obligations. So if you are adding a particular debt, then your situation might be projected for the cash flow. And if you're projecting cash flow, then you need some good projections in order to do so. The other thing that a lot of people, as we look at the ratio one more time, a lot of people don't understand is that most lenders, many lenders at least, will compare your situation with your industry. So when they get your NACE code, what they're going to do is they're going to look at your particular situation, and then they're going to have a compilation of maybe 200 or 300 financial statements, and they could be profit and loss statements or balance sheets that have been compiled for them. So they're going to look at basically financial ratios in your industry. It's important for you to know where you're going to be strong and where you're going to be weak as you compare your business to the industry that you're in, because your lender is going to do it for you when they go to try to look and approve a loan for you. So two really important things: your debt service cash flow ratio, and also understanding that your financial ratios, your financial situation is going to be compared to your particular industry. Okay, so strategic partners, this is kind of a really unique way. It's really kind of one of my favorite ways for unique ways of trying to figure out a creative way to go into business, an alternative source rather than going through your particular lender. And over the years, I've seen it implemented a number of different ways. One way, on a very, very small way, was that a woman who actually ran a craft fair, Thanksgiving weekend, had a nice craft fair, had 50, 75, 100 booths. And some people didn't have the cash reserves in order to actually get an inventory to sell at that particular fair. So she would actually fund them some money in order to come up with that, and then they would pay her back afterwards. Kind of a smaller one, but on a much bigger situation, I saw it for a multi-million-dollar acquisition. And essentially what it was is that one company was actually buying a few $1 million a year of raw material through another organization. And they knew that if it sold to somebody else, that they would lose that business. So they were getting $3 million a year. And so they were able to make a cash investment into that business. And that cash investment was enough to steer it into a small business loan where they were able to acquire and then keep that particular supplier on board. So two different angles, but really creativity at its best. Again, in that last situation, the strategic partner was a funding angel. It was mutually beneficial for both. They were able to buy the company, and then the actual supplier was able to continue to supply and have sales of a few $1 million of their raw material. So, it is common, and it goes from very formal to extremely casual. That's the two examples I just gave you. Okay, on this particular area, you've probably seen this if you've been on Webinar Wednesday before, because we have showed this a lot. And it's basically the $1 billion that has come now to California. We're trying to get it out and get it out to a variety of different small businesses. And essentially, this came from the American Rescue Plan Act and was kind of a program that had been around for about 10 years through the last stimulus. When President Biden was vice president, actually, they came out with this program. So what it's designed to do is it's designed to provide state programs that offer and support small business financing. So $1 billion goes to the state of California, that's used between the IBank and also the California Pollution Control Finance Authority through their California Capital Access Program, or CalCap. So both of these, their goal is to deploy capital to socially and economic disadvantaged individuals. A couple of the programs include, one of them has basically a venture capital component to it. So as the debt, the $1 billion in debt, is through a variety of these regional corporations, development corporations in California. We have one in Fresno, Valley Small Business Development, and also Cal Coastal in Salinas, SBDC, but also one of these particular lenders. And there's a variety of different programs. So not only do they make guaranteed loans to where they get the state to guarantee it with that $1 billion, but also there's one unique program that actually covers collateral if you're low on collateral. So let's say you had, let's just go with a building, a commercial piece of property. And for some reason, you kind of got upside down on it, and maybe the collateral support would be enough to actually allow you to get a better financing package. So, or a small business that doesn't have much collateral and really needs working capital and permanent working capital, inventory, they need to pay their people, etc. So a couple of unique programs that they have there. When more comes out on this particular venture capital aspect of it, so that would be investment for underrepresented venture capital managers that serve underserved entrepreneurs and business owners, we will keep you apprised of that situation. So moving on, and one other aspect that I get asked a lot about, so we thought we would cover today, is now a good time to sell my business? And well, first of all, I think it's a good time if you have a buyer and you have a price that you think it's worth. It's a great time. It could be a good time for a variety of other reasons. If you've been able to plan in advance and actually, kind of maximize your profit for that particular business. You get the business lean, you take out a lot of maybe your personal expenditures that wouldn't go over to a new owner, and you make the business look like it would if you didn't own it. And maybe, it's kind of a relearning process, because we're taught as business owners, you want to minimize your taxes. Oftentimes you want to minimize the income tax that you pay on your small business. And so we try to get it as much in there as we can and try to get our profit as small. Well, it's different when you're trying to sell your business. You want to maximize the profit. You want to show the value and the true value of that particular business. So that is one step, one strategy is to, if it's a good time, how profitable is your business? Because really, your profitability and your financial history is really going to be the benchmark for what your business is worth. A lot of people think that if they start their business, and even if it hasn't operated profitably, that it is still worth a lot of money. And it can be, but more often not, it's worth more if you have strong financials for the new owner to move into that business and it to be unaffected by you leaving and exiting that business. So one thing that I see oftentimes when we're talking about, and we're using the buying and selling interchangeably, because essentially the advice that we're giving works both ways. But really, you need to be realistic on your price and your other terms. Every buyer I talk to seems to think their business is worth more than it is. I know that's not the case, but I think it's definitely the 80-20 rule coming into full force view. 80% of sellers think that their business is worth more than it is. And they think that the other terms, in order to facilitate that sale, is going to be, something that doesn't require them to potentially take back some of the business as far as financing it. So the other tip that I can give you on this is to explore the best method to sell your business. And for many of you, that would be, every situation is different. So it could be, It could be potentially a broker, using a business broker, somebody who's experienced selling businesses. You could use the internet. There's platforms on the internet. You can use yourself or sell it to somebody you already know who you're going to be selling it to, which is always good. But really, before you start discussing this, try to get a good valuation of what the value is. And when we talk about value for the business and what it's worth, it's going to be a subjective analysis. Everybody is going to calculate that differently. I'll calculate it differently than, say, a CPA. I can calculate it differently from another of our SBDC business consultants. Two CPAs in the same room talking to the same person will come up with a different valuation. So that's common. For me, when I look at valuation and valuing a small business, there's different methods. One of them is the rule of thumb. And we have a nice thick book of just the rule of thumb, and that's exactly what it is. It's a starting point. It's the starting point for your particular industry, your particular size of your business. And, oftentimes it's shown as a variable of sales. So maybe in a particular business, let's say you're a fertilizer wholesaler. Kind of an interesting time for your business, given the fact that it's been impacted by the war so much. But you're pretty much then going and you're going off of oftentimes what the rule of thumb says, and maybe it's worth 1.5 times your sales. Wow, my sales are $1 million. My business is worth 1.5 million. Whatever that rule of thumb is. The next way of defining a value for that is to do some type of assessment. And there are assessments that are done by brokers about a probable selling price and what they think your business is worth. There are oftentimes businesses that do this. I know lenders each have their own, like they have appraisers. They have appraisers also for the valuation of a business, and they will take the information. Usually the last two that I talked about, getting it from a broker or the appraiser, is a fee that you're going to have to pay. But it's a good idea to know what the value of your business is before you get going too far down that particular road. So in tying back our financial discussion that we had and now buying a business, let me show you an example of, this was a few years back, but it's possible to buy a business with zero down. How do you do that? Well, if everything else is solid in your situation, meaning that, you have maybe good credit, you have experience in the industry, which is always important when you're buying a business, and potentially you have some collateral for the loan, you have some capital, maybe that you're putting in, maybe it's not cash. So, you have a solid situation, you just don't have that down payment. So it's possible, and this is based on an SBA loan, it's in the SBA standard operating procedures, that there is a thing called standby interest. So you could actually buy a business with zero down. Let's go with you're buying a business that has a $300,000 selling price. You're getting a $200,000 SBA loan, and the owner will finance $100,000. So the term of the SBA loan is 5 years. There's good cash flow from that business. It makes really a good sense. Even by adding this debt into it, the cash flows out. Your lender likes it. So how it works is with standby interest, you agree that the $100,000 that is being owner financed will not be repaid, at least except for the interest. No principal will be repaid until the SBA loan is paid off. So you can still pay interest-only payments, but you cannot repay the principal. Well, let's say you have an inheritance, you want to get rid of it. If you were to talk to us at the SBDC, I'd probably tell you, please don't do that. Please don't pay it off outside of these terms, because how could you get tripped up on this? Well, oftentimes your SBA lender is going to require your financial statements. And if you had a note payable to, well, let's just say JP Bungler or JS West, whoever, you know, what happens is you have $100,000 out there, and it was on notes payable on your balance sheet. Now it's gone. Your lender might ask about it, and it could call the loan. But that's in one situation. Okay, so a little bit there on selling the particular business. We've hit my 3 Q points. I'm going to move on now to our community calendar. You know, I had been promoting the Indian Wells Valley Economic Outlook Conference that was last week. And, you know, just in fair dignity, you know, there was only 3 of us that made it over there. One of them was the speaker, Dr. Aaron Hedgay, who was professor and chair. He shared a few of the slides that he presented, since I know only 3 people could get over 58 because the pass was closed. So just a few things that I thought were kind of interesting at the Economic Outlook Conference that was on our community calendar. And one of them was, we were in Ridgecrest. Ridgecrest is a military town. And he took us back with this graph. And thank you, Dr. Hedgay, for sharing these slides with us. I only got 3 or 4 of them to go over real quick, but this was, I think, was really fascinating from that Outlook conference. And that was that defense spending as a percentage of our gross national product. You look at 1960, it was 9%. 9%. And the spending, billions of dollars, just very, very small. And you see, as we've gone from 1960 over the next 60 years, and there's a huge gap difference. As a percentage of spending, it's only around 3% now of our gross domestic product, everything that the economy produces, while our gross domestic product is around 800 billion a year, growing substantially. So that was surprising on kind of a larger note. Also, he shared with us the labor force participation rate that goes back around the same time, and the percentage of people that were in the labor market, and really it kind of peaked in 2020. But still, it is starting to come back from where it was just a few in 2020 with the pandemic. So kind of an interesting forecast there on where labor is. We've been talking about a lot about labor. And he talked a little bit about being in Ridgecrest and about how the war in Ukraine was setting back the global economy and the effect that it had on the global economy, and showed some pre-war and post-war outbreak projections there. And also one of the things that where a lot of us really don't think of, it's food imports, and a lot of the damage was to a lot of third world countries where Ukraine was exporting food. And there's our Kern County real gross domestic product over the last 10 years that was covered as well. So our community coming attractions, the Bakersfield Women's Business Conference will be coming up on April the 27th. Damon Johns, the People Shark, will be there. And then also the community calendar has the Kern Economic Summit, which will be telecast on TV. Used to be an in-person event, but they've done it on television for an hour and a half on a Saturday afternoon, early evening actually. So that'll be coming up as well. For those of you that are out there looking for you know, your local businesses, and you're looking nonprofits, and you're looking to work with a student class at CSUB, talk to Dr. Zhu at you see his email, cxu3@csub.edu. So Jimmy Zhu is waiting for you. You can find most of our content that we do in these webinars on our CSUB SBDC YouTube channel. A lot of them aren't there, a lot of my favorites, but here's some oldies but goodies. Going back, if you want to call one from about 6 weeks ago, old, but it's on HR and California law, so it's not. And a lot of really good topics out there. Our SBDC toolbox, contact your SBDC, live plan for business planning, SBDC Net. Next week, we'll be back with Richard Mostert, Dr. Richard Mostert of the Valley Community SBDC. And so that, I believe, fills that up nicely. So now let's go to your questions and see what you have. And we'll stop the share there. get back to my snow falling, and go to the chat and see that Maureen has done a fine job of feeding the chat box. Thank you, Maureen. We'll see information on that micro grant program still in Kern County. We'll see stuff on FEMA and storm damage that we had. And a question on, can I reach out and see your thoughts on bankability? Absolutely. Contact your local SBDC. And I know a lot of people have complex situations, so it is better to reach out individually, one-on-one, when your situation is complex. Absolutely. So there we go. Dr. Jimmy Zhu, and his contact information is in there. Maureen has our YouTube channel there, and no more questions. No questions for me today. I came prepared for questions. And I just have a little bit of dusting behind me. Look, that rail's only got, 3 inches of snow, unlike many of you out there. Okay, well, if we don't have questions, then we're going to call it a webinar a few minutes early. So we'll be back next week. We'll be back next week with Richard Mostert, and Mr. Mostert will be joining us for webinar number 266 in the Valley Community SBDC, on a lot of the things that are going on with small business financing and a lot of things that are coming to the San Joaquin Valley Finance Center. So for our producer, Maureen Busher-Dang, thank you for joining us. We'll see you next week, everybody. Take care and bye-bye.